Hey everyone, welcome to the International Tax Anti-Avoidance chapter. So this chapter is about regimes which help prevent international tax avoidance by people recording income in foreign jurisdictions that have very low tax rates. For example, the Cayman Islands, which is effectively a 0% tax rate over there. So this is basically just a rule and systems implemented by the Australian Tax Office, and it's very similar schemes in other Western countries as well, which basically says, even if you have income in those countries, those jurisdictions, we're going to still treat it as income as if you earned it over here in certain rules, which we'll talk about a little bit later. But mostly it's to do with passive income, which is a concept of money which you haven't earned through running a business. It's more just where have you parked your money and how have you earned your money on that parked money. For example, dividends, royalties, etc. Because you can effectively earn that globally. So the question is, if you're going to earn it in the Cayman Islands and pay 0% tax, then you might as well, it's no different if you say you earned it in Australia. So we're just going to say that, and we're going to tax you at the higher rate to prevent international tax avoidance, basically. So that's what this chapter is all about. So let's go through this now in a bit more detail. So first of all, let's just talk about attribution regimes or anti-deferral regimes, which is effectively the technical word for the concept I was just discussing, which is basically we've got these international attribution systems. Attributions meaning it's saying the tax office is saying we're going to attribute the income to one person. So even if it's earned in one country, we're going to attribute it to this country and say, well, you're actually earning it in principle in this country. So we're going to assume it like that, even though the money might not actually travel to that country. Next, it's designed to prevent income from being accumulated in foreign jurisdiction that does not have comparable tax rate to that income in Australia, for example. So a good example here is Australia with a tax rate of around 40 to 50%, depending on as an individual, depending on which threshold you're in, versus in the Cayman Islands where it's effectively a 0% tax rate. Now there's referred to accruals regime. So basically what this is saying is when it falls under an attribution regime, the income that has been attributed to Australia is taxed on an accruals basis, i.e. it's taxed as it's earned, not when it's repaid. So it's accruals versus cash, similar to what we talk about in tax and also the fin modules. But this has a particular relevance here because under a cash methodology, it would be when the money is repatriated back to Australia, as opposed to earned in that country. So for example, you might have rental income in the Cayman Islands or royalty income in the Cayman Islands, you're paying 0% tax. You might not actually repatriate that dividend back to Australia, just keep it in the Cayman Islands and say, well, even though it's been attributed to Australia, I'm just not going to pay a dividend back to Australia, therefore you can't get me. Well, what the Australian government is saying under the accruals, on an accruals regime is, well, actually it's when you've earned the money and you've already earned it. The cash is overseas, but you've earned it, therefore we're going to attribute it to Australia on an accruals basis, therefore it's assessable in Australia. Okay, so there's two attribution schemes. There's one that's controlled foreign company rules, CFC rules. We kind of talked about CFCs a fair bit in the last chapter. And number two is transfer at trust rules. So let's talk about the first one, controlled foreign company, CFC. So that's similar, as I mentioned before, in the last chapter, where you've got an arrangement like this, where you've got an Australian company and you've got a foreign company. The Australian company controls the foreign company. So control has specific definitions, but at a high level, it's basically you may control majority interest in the company, or you actually can persuade and have substantial impact on how the company's run, management decisions, and so forth like that. But generally, if you don't know that, then ownership percentage is the best guide, and it's usually 50%. More than 50% is usually the indicator of whether you control a company or not. But it is a little bit more complicated than that. Anyway, so that's what a CFC arrangement is. Now, there are a few specific rules and caveats around that. So number one is the foreign entity must be a company. Otherwise, we're not talking about CFCs. We're talking about something else. So the foreign entity must be a company. Secondly, the person controlling it, or the entity or person or whatever it is, controlling that foreign company must be an Australian resident. Now, the Australian entity doesn't need to be a company. Okay, so it could be an Australian individual controlling a foreign company, could be an Australian trust controlling a foreign company, could be an Australian company controlling a foreign company. It doesn't matter as long as the other the entity being controlled is a foreign company, then this is applicable. And as we mentioned before, if it falls under the CFC regime, attribution regime, the purpose of this is to actually get that money attributed back to Australia, so the Australian government doesn't miss out on the tax overseas. So there's a few steps here. So first step is to ask the question, does the CFC regime actually apply? It's like FBT, right? It might seem like FBT on the surface, but then if it doesn't satisfy the very strict and specific definition of whether an event occurs, FBT for the FBT example or CFC regime for this example, there may not even be a CFC regime applicable, right? So definitions are important in tax. Okay, so the first point here is only a company can be a CFC, which we mentioned before. The foreign company must be a company. A company must be foreign, i.e. non-resident, and controlled by an Australian resident. So we talked about that already as well. And then finally, there are 3 control tests. So there must actually be that control in the arrangement. So how do you define control under the CFC regime? Well, there's a few tests, and if you don't satisfy the first one, you move on to the second one. If you don't satisfy the second, you move on to the third one, and so forth. So the first test is, do you own more than 50% of this foreign company? And the ownership is 5 or less Australian residents. So that would prevent, for example, a listed company in the Cayman Islands being impacted by this, because there are obviously hundreds of shareholders, thousands of shareholders, even millions of shareholders in some instances. Right, so it's more about private investments, okay? So it's 5 or less. So if you own 50% or more, so let's say I'm an Australian resident, I own a company, foreign company, I own 51% of it. The other shareholders, there are 5 in total. Then the strict control test applies and the CFC regime applies. Next example, let's say this didn't apply in the first situation. Let's say maybe I had 49%. The next test I would check is assumed controller test, foreign companies or CFC, if a single Australian entity has an associate inclusive control of 40%, and the company is not otherwise controlled by an unrelated entity, i.e. not another 60% shareholder. So what this is saying is, okay, so even if you have less than 50%, you can still be assumed to control it if you own greater than 40%. So in this situation, the 49% could still be applicable because that's greater than the 40% number. But the only way that this would occur is, well, first of all, it's a single Australian entity. Secondly, the other shareholders is not a 60% shareholder. So for example, if I have a 49% holding, if the other shareholder owns 51%, in fact, I'm going to change this to 40% just to make it really clear, but it would also be applicable for 49 and 51. But just so I match with the question of what I'm saying, if this example, it was me, one shareholder, Australian resident, own 40% of a foreign company. Another shareholder, shareholder 1, shareholder 2, owns 60%. This would not apply. Okay? What this is saying is this would only apply if shareholder 2 owned, for example, 30%, and then shareholder 3 owned another, did I do that right? No, 20%, 70, no, that was right. So if it was 30, 30, 40, I own 40, then it would apply, and we would say that I would actually have control of this company. And it makes sense, right? Because there's 3 shareholders, I own 40%, they own 30 and 30, therefore I own control. So what this is just basically saying is this situation here would be control, but this situation here would not be control because there's one other shareholder who owns more. What about this? What if I own 49% and they own 51%? Well, there would not be control because this other guy owns more than me. But if he owned 48% and there was another shareholder who owned 3%, then yes, I would have control of this company even though I own less than 50%. So that's what this is saying. Anyway, and then the final one is de facto control test. So let's say the answer to this is no. A foreign company is a CFC if it is otherwise controlled by a group of 5 or fewer Australian residents. Ownership includes entitlement to acquire an interest, e.g. an option. So let's say we've got myself. So let's say we've just got 5 shareholders. Each of us own, 20%. it would still be a foreign company as long as there are 5 or fewer Australian resident shareholders. Okay, so it pretty much picks up most situations. It really just prevents, large publicly traded organizations with multiple shareholders. It excludes them from this. Otherwise, most foreign-controlled companies are picked up as part of this test. Okay, so step 2 is, does the CFC pass the active income test, right? So the purpose of this is this step, and next few steps is what I mentioned before about that split between passive income and active income, right? So the government wants to punish passive income being over there. The government does not want to punish active income. The reason for that is, think about Coca-Cola, right? Coca-Cola is going to have businesses in almost every country in the world, even Cuba, even the tax havens. So even the Cayman Islands, Coca-Cola will be present there. They have an active business. They produce, they manufacture, they import, they have staff, they have offices. They run a business, right? They sell products, they sell consumer products. The ATO and other governments don't want those genuine businesses to be impacted by this. This is purely to avoid tax evasion. So you always got to think about, what is the purpose of this, the big picture stuff here, right? So the big picture stuff is the ATO want to stop people like, rich individuals. They might own $10 million, $50 million, transferring the money over to the Cayman Islands, getting 10% interest return a year on $100 million is $10 million a year. That's going untaxed, right? Because if they just parked it in Australia, they'd be paying up to 50% tax on that income. So it's really just to prevent that kind of income. So we call that passive income. But for the purpose of CFC testing, the technical wording that we're going to be talking about is tainted income. Okay, so tainted income is the bad income. That's the passive income that's actually going to be brought back to Australia for tax purposes. So the active income test is meant to basically distinguish those two groups of income and figure out, what's the impact, which amounts do we need to actually attribute back to Australia. So the active income test basically categorizes all sources of income as tainted or not. So the tainted income is going to be non-business income, e.g. passive incomes, dividends, interest, royalties, rent, and also capital gains from disposal of tainted assets. Now, they specifically mentioned tainted assets here, not just said capital gains in general. The reason is because, Coca-Cola, for example, if they're disposing of the plant and equipment, we don't want to just pull this in with the non-active income. That was active income, that produced active income, so therefore the capital gain on that equipment should, depending on if it's capital gain or balancing adjustment, should be active income and not be penalized. But if it's something like you're selling your shares, selling shares in a company that only produced tainted income, i.e. passive income, then we want to treat that capital gain as tainted income as well. So the active income test is what we're required to do to basically figure out where does your business fit on the scale of tainted versus non-tainted, and then the implication in terms of how we actually treat that for attribution. So the active income test is calculated as, and this is called the tainted income ratio, your gross tainted turnover divided by gross turnover. So in other simple words, what this means is, what percentage of your total revenue is passive income? If it's less than 5%, you've passed the active income test. If it's greater than 5% of tainted turnover, then you have not passed it. Now, it's good if you've passed it because it means that 95% of your income is active, that you run a business 95%. So the ATO actually allows a leeway of 5%. Okay, so step 3 is actually calculate the amount that's attributable, and we're going to need to know how much the attributable income is and what's the attribution percentage, which you can get from the steps above, right? Okay, so the amount assessable, which you need to include in your Australian tax return if you're an Australian resident and you control a controlled foreign company. So it's going to be attributable income times your attribution percentage. So how you calculate each of these parts are discussed a little bit more down below. But basically, CFC attributable income is calculated on certain assumptions. So number 1, that is taxpayer and resident of Australia, which we covered. Apply legislation as a resident taxpayer, but with modification. Okay, it's just a minor point. The formula to calculate your CFC attributable income, which fits in this formula up here, is basically your notional assessable income minus your notional assessable deductions. Now, what this means is it's basically depending on where your income is earned. So just think about it this way. Block out the notional for a second. So it's just your normal assessable income minus your deductions. This notional word basically relates to where it's earned. Okay? So your notional assessable income is equal to your adjusted tainted income plus your concessionally taxed income in listed country. So first of all, let's figure out what listed country and unlisted country means. Okay, so a listed country are the good countries. They're countries with, relatively strong tax systems, double tax treaties, etc. Unlisted countries is every other country. So let me quickly bring in the CSG on this one. Okay, here we go here. So a listed country is generally those with broad-based taxation systems similar to Australia. So listed countries are Canada, France, Germany, Japan, New Zealand, UK, United States. All other countries are unlisted countries. So that's the way to think about it. So for example, if we choose a random country like Pakistan, it's obviously going to be unlisted because it's not one of those, 1, 2, 3, 4, 5, 6, 7 countries, the good countries, similar taxation system countries that are listed countries. If it's not, then it's unlisted. Fairly straightforward. If you're not sure, most likely it's going to be unlisted. Okay, so let's go through the different rules and how we actually calculate assessable amount based on whether it's a CFC, a controlled foreign company, in a listed country or an unlisted country. So for example, let's consider a situation with New Zealand, right? So New Zealand would be a listed country because it's right there, New Zealand. All right, so how we calculate notional assessable income in New Zealand would be its adjusted tainted income. And remember what tainted income, it's what we calculated above. So it's basically any non-business income, capital gains from disposal of tainted assets, and so forth. Plus concessionally taxed income in listed country. What does this mean? It means where there's a different tax rule in those countries than it is in Australia on how they treat certain classes of income. So for example, the most obvious one and the one that always gets used in exams, in fact, I would wager that this is the only example that will ever be used for this question, is the fact that in New Zealand, they do not have capital gains tax. So if you have a capital gains in New Zealand, you don't pay any tax on it. Whereas if it was in Australia, you would pay capital gains tax on it. So this is why we have this second part here. It's because, yes, you have to include, if you look at New Zealand tax return and say, okay, I got interest income of X amount, I got royalty income of X amount, you have to include that in Australia. But not only that, because in your New Zealand tax return, you're not going to show your capital gain because it's not taxed in New Zealand. But you also have to include that income which is concessionally taxed. So capital gains is one of those examples which is concessionally taxed in New Zealand. And we actually we add up the two, and that's going to be our notional assessable income. So for example, in New Zealand, we're going to, we've figured out it's a CFC, we've gone through our control tests, we're going to add in our interest income, we're going to add in our royalty income, we're going to add in our capital gain, we're going to assess that as our notional assessable income, and then also figure out what deductions we were allowed against that income as well, and that will be our attributable income. Okay, but if you're in an unlisted country, it's a little bit simpler. It doesn't make a lot of sense, but it's only your adjusted tainted income. So it's basically your passive income, your tainted sales income, your tainted service income, and so forth. Now your notional allowable deductions, which is the second part which we mentioned, it must be in relation to gaining that notional assessable income. You can't claim deductions which aren't in relation to gaining that notional income. It also allows notional deduction for tax paid in respect to amounts included in notional assessable income. Okay, and then third is attributable tax payers. That's basically who it is that it's attributable to. In the situation, if you own 100% of the company, you're the attributable taxpayer. Okay, and the attributable percentage is that taxpayer. What's their direct and indirect ownership percentage in that CFC? So it's fairly straightforward. You say I own 60% of this CFC. You figure out what their assessable income is. You times it by 60%. That's what you have to include in the attributable taxpayers tax return in Australia. So let's just do a quick example here from the CSG just to hammer home these points. So we've got an example here where we've got AusCo, Australian Resident Company, which is important because we know that satisfies one side of the definition, as long as the other side is a foreign company, which it is. It's a New Zealand company, so that satisfies it. So the only test remaining is, do we have control of this company? Which, unless we see otherwise, I'm going to assume that we do. So they own a small business and that has rental property, e.g. a passive asset, so it's not an active asset, on which it earns rental income. Okay, Newco disposes of the rental property and makes a gain of 200k. Rent is taxed, but capital gains is not. So it's a CFC, so it confirms that in the question. New Zealand doesn't have capital gains tax regime. It's not taxable in New Zealand. Therefore, it fails. Therefore, if they fail the active income test for the current year, which we're assuming from the question that they do, the gain on the disposal may be attributed to AusCo. Rent is not designated concession income in New Zealand and will not be attributed to AusCo. AusCo is an attributable taxpayer and has an attribution percentage of 100%. Therefore, 100% of the 200k is potentially assessable in Australia in the current income year. Okay, so basically what's going to happen is, because it's a listed company, we've established that the CFC regime applies. So what's going to happen is we're going to add in the concessionally taxed income of the capital gain in New Zealand into the Australian's tax return because it's deemed to be Australian income. So that's basically all you need to know for controlled foreign companies. So let's move on to the next one, which is transfer of trusts. So this one's a lot shorter. It's fairly straightforward. So in fact, in the CSG, they only spend about 2 paragraphs on this in total, and it moves on. But it's basically just, so you don't really get assessed on those own exams, but it's basically saying that under the Income Tax Act 1936, Division 6 of that says basically the general trust provisions either taxes the trustee or the beneficiary, depending on how the assessable income is reported, how it's structured, and so forth. And the CSG basically says, look, it's easy to avoid by basically saying that if the trustee is overseas, and just to ensure the beneficiary doesn't have an interest in the trust. That's basically all you need to know. You're not going to get assessed on it. So let's just move on to the next one. So thin cap. So thin cap's pretty important. So thin cap is a concept, and this is where we're starting to get onto this. Okay, so we've established that we can assess income back to Australia if it's in these low tax jurisdictions, but there are actual ways that companies can get money out of companies into lower tax rate jurisdictions, like legitimately. For example, charging a management fee. If you've got, and this is what Apple and a lot of large companies do, is they make billions of dollars in Australia, but their head office in Ireland actually says, oh well, we actually need to charge you 50% of your revenue as a management fee because all of our corporate overhead is in Ireland. So that's just to cover the cost that we're incurring of servicing this business, and it's a genuine cost. It's hard to argue that it's not a genuine cost, but it is suspicious that these companies are charging so much. They're located in low cost jurisdictions. So at what point do you cut this off and say, no, like you can't, because what that does is that expense for the Australian company reduces the taxable income, but it's actually revenue in that other low tax jurisdiction like Ireland. So they're reporting revenue that was earned in Australia, in Ireland paying low tax than if they didn't charge that management fee and pay the tax in Australia. So it's not just management fees, they also do it for debt as well. So for example, you can have interest payments back to your parent company. There's also a concept called transfer pricing, which we'll talk about a little bit later. It's basically where you sell products to your parent company at really high prices. At really low prices. So you don't make any money in Australia, but the parent company does make money, if especially if they sell that on to someone else, basically. But the most important thing is they don't pay tax in Australia when they probably would have if they didn't apply this. So thin cap is to do with restrictions around the debt side of that. So we mentioned management fees, debt, and transfer pricing. This is to do with the debt side. So this is where the government says, because obviously if you have a lot of debt in your company, you can claim an interest expense, and that will reduce your taxable income if you're a business. Now, some companies will say, okay, I've got to borrow money, or maybe they don't even need money, but they say, look, I'm going to pay 30-40% tax in Australia, Okay, if you're a company, probably it's going to be 30%, but still, let's just take out a whole bunch of debt in Australia. We'll cover that in interest expense. We can earn a lot more money on that debt, or we can just send that money back as repatriation back to our parent company. It doesn't bother us. So the ATO actually has these rules as to say, okay, you can actually claim. So you might have the interest deduction of $1 million, but depending on your situation, you can only claim 50% of it, or 10%, or whatever it is. So that actually prevents companies from structuring their debt to equity profile, or the capital structuring, in a way that they can avoid tax. So that's what thin cap is. So thin cap occurs when a multinational entity finances its Oz operations with a lot of debt, e.g. bank loans, related party loans, compared to equity, i.e. share capital reserves, retained earnings, etc. i.e. equity capitalization is thin. So you say it's thin capitalization because they've got a lot of debt and not a lot of equity. Okay, and this is trying to balance that out and bring equity up and bring debt down to avoid tax avoidance. So it's attractive to companies to structure their business as having lots of debt because you get a deduction for interest, whereas if it's equity, you don't get deductions. Like, for example, you pay a dividend, a company's not going to get a deduction for a dividend. So debt in Australia provides greater deductions, with interest income being assessed at lower rate in a foreign country, e.g. shifting profits from Australia to the foreign company, and profits are taxed at 30%, interest taxed at 10% withholding tax. Yeah, so there's a lower tax rate. That's another good point. So there's a lower tax rate for any interest, right? So you're going to pay 10% withholding tax, but for profits you're going to pay 30% tax. So Division 820 sets the scene in thin cap as to how much debt a multinational can actually have. And when you exceed that limit, you don't actually get access to those debt deductions in your income tax return. So for non-bank nationals, upper debt limit or debt to equity ratio is 1.5 to 1. E.g. the cap is for $1.50 of debt, you must have $1 of equity. So let's go through the flowchart / logical step process to figure out whether thin cap rules apply. So it applies to all Australian entities. So it could be individuals, trusts, partnership, companies, all of them, but they must be Australian. So it doesn't apply when an entity has no debt deductions. It's irrelevant, right? Because if they don't have debt deductions, then there's no need to figure out what the maximum debt deduction capacity is, max limit is, via thin cap rules. So it's irrelevant. Number 2, if debt deductions are less than $2 million, then de minimis exception applies. So it's not necessarily applicable. So it's really to do with very large, companies shifting profits overseas. Number 3, wholly onshore operation. E.g. the Oz resident entity is not an inward/outward investing entity. Okay, so again, it doesn't matter about thin cap if it's only an Australian entity, they're not repatriating funds overseas, they're not owned by a foreign company. If all of their operations are internal, there's no transfer of money outside the country, then thin cap, again, doesn't apply, and it's not relevant because the purpose is to avoid profit shifting to a low tax jurisdiction. Okay, wholly offshore operation. Again, this is similar, but in inverse, because if the company is overseas, they've got no connection with Australia, they're not going to be reporting any income in Australia anyway. So therefore, thin cap is not applicable, it's not relevant. And then finally, outward investor is not foreign controlled and meets asset threshold test. So very similar to point 3, it's basically, yes, they invest money overseas, but they're not controlled by any foreign entity. Okay, chart down here, which basically summarizes what we're talking about. But up here, I think this summarizes a bit easier to understand, but there's a flow chart if you prefer to, think that way as well. So step 2 is classify the taxpayer. So Division 820 recognizes 3 types of taxpayers. Number 1, ADIs, or this is authorized deposit taking institutions, financial entities, non-ADIs. And each of these, they're distinguished between inward and outward investing, i.e. are you investing in Australia or are you investing overseas? Okay, so they're the 3 categories. So either you're an ADI, e.g. a bank, you're a financial entity, e.g. a financial advice firm, or a non-ADI. So that could be most companies like a small business or marketing firm or a lawyer. Most of them will probably be in that non-ADI category. So non-ADIs and non-financial taxpayers are classified as one of these options, so either inward or your outward investor. So if you're inward, you're investing directly via a controlled entity, and it's or directly via permanent establishment. And an outward investor is called an outward investing entity. So if an entity is both inward and outward investing, the outward investing rules apply, i.e. tiebreaker. And when taxpayers transfer between classifications, e.g. they change between outward and internal investment, it means there are two separate capitalization periods that need to be assessed separately. There's some examples here that you can actually read through and use as some examples as to figure out whether a company is inward or outward facing. There's a table here you can refer to just for some guidance around outward, inward. You can read it here for reference, but it's basically think about where is the money coming from, where is it going, what's the purpose, how is it structured. So for example, we've got an Australian company has a subsidiary meaning they've got a separate company in Australia. So the head company is Australian, it's investing money in New Zealand, therefore it's an outward investor, because this is from the perspective of Australia. It's an outward investor, and it's for the Australian company because they're the ones with the source of the money. Right, second example is Australian company established by a New Zealand company, so it's a New Zealand headco establishing another Australian company. The Australian company is a new entity, and both of them carry on a marketing business. So the Australian company is the inward investment vehicle, so it's the vehicle where the money is coming to, and it's inward, so it's going to Australia. And the final one is an Australian branch. So branch means permanent establishment. It means that they haven't set up a new company. It just means it's the New Zealand company operating in Australia without any legal infrastructure, and they carry on a business. So again, that would be New Zealand company, but the interesting thing is it's inward investor, right? It's not investor vehicle, it's inward investor. It's inward because it's heading towards Australia, and it's investor, not investment vehicle, because there's no investment entity in Australia. It's just the New Zealand one, so it's investor general. So that's basically how you do it. There are different implications down here in terms of whether you're going to be an outward investing entity, an inward investor, or an inward investment vehicle. Hopefully these scenarios give this some context as to what you use, but typically they're all pretty much the same. Okay, there's only a few minor nuanced differences. I remember I have seen exam questions on this before though. So basically step one is figure out which classification of entity it is, and then you literally just follow this flow chart as you go through it. So, does the entity's adjusted average debt exceed its maximum allowable debt? Okay, so maximum allowable debt is there's definitions down here, but that's basically the maximum debt that you can actually have in the company. There's your section reference. They all use the same one up here for all entities. Then your adjusted average debt is slightly different section reference for outward versus inward. And it means the average debt of the entity adjusted for certain factors. Only debts giving rise to debt deductions are included, and debts used in the entity's foreign operations are excluded. Okay. Average values are calculated in accordance with subdivision 820-G. This one's different because it's outward, and the foreign operations are excluded, which is why it's different here. Next one, maximum allowable debt is the greater of the entity's safe harbor debt amount. This is basically the maximum amount of debt that you can have, and above that threshold, you're not allowed to claim interest deductions anymore. It's the greater of the entity's safe harbor debt amount, arm's length debt amount, and we talk about how we calculate these down the bottom in certain situations. So the only difference here is this different section reference, otherwise the definition is the same. Safe harbor debt amount is 3/5, i.e. 60% of the average value of the entity's assets used to produce Australian assessable income. This excludes assets used in the entity's overseas operations. So basically what you do is you calculate all the assets related to the used to produce the Australian assessable income. You take 60% of that, and you ignore all assets related to foreign overseas investment. Then you take the arm's length debt amount, the amount of debt that the entity could borrow from a third party. So you go to the bank, what's the maximum borrowing capacity of that entity? There's the section reference. Then finally, worldwide gearing debt amount gives an entity the ability to gear up to 100% of the gearing of the entity's worldwide group. So you've got to take into account your related entities and say, what's your 100% gearing of that amount? So you calculate what these three numbers are. Safe harbor debt, arm's length debt, worldwide gearing amount. What's the dollar value for all three of these? And then we figure out what's the highest of the three, and that's your maximum allowable debt. That's your threshold. And above that, you can't claim any interest deductions on that. And it says here, proportionally denied above that threshold. There's your section references over here. So, process is going to be exactly the same depending on what entity it is, but it's going to impact your section reference. And some of them you may or may not have foreign operations, so you might need to exclude that for certain sections as well. But otherwise, it's fairly straightforward. Follow the table, include the right section references. We've got a summary over here. So step 4 as well is calculate the debt deduction denied. So you just compare the average debt with maximum allowable debt. I mean, it's basically covered up here, but this is just to really hammer it home. You disallow part of the deductions if the adjusted average debt is greater than the maximum allowable debt, which we established was the higher of these three. And then we've got the calculations for each of those. So the adjusted average debt, which we mentioned up there, is the average of debt, but adjusted for certain items. So it's opening plus closing divided by 2. That's the average value. And the debt capital includes amounts that give rise to debt deductions, e.g. interest, so for loan from banks and related party, but it excludes non-debt liabilities. So it wouldn't include, for example, provision for restructuring. It wouldn't include trade creditors, accruals, all those working capital items. It wouldn't include it. It's only debt items. So there's the distinction between working capital and debt. Working capital are items that you need on a day-to-day business in your basis, like inventory, your provisions, your accruals, your trade creditors, your inventory, your leave provisions, and so forth. They're not debt. Debt is just cash, loans, related party loans, borrowings, things like that. Okay, and this is the formula to calculate adjusted average debt. So of course, the formula that we want to know is adjusted average debt. We want to know the maximum allowable debt. So because the difference between those two is the amount of interest that's disallowed. So the first part is the average adjusted debt, which we covered off in the first part about the formula. These are the steps to go through, and actually which items you would adjust and don't adjust as well. So we've figured out what the average value debt, let's say it's $1 million, then we look for these things as well, depending on which type of entity it is. So let's say it's an outward investing entity. We go to this step here, which is we adjust for associate entity debt. We adjust for controlled foreign entity debt. But if you're an inward investor, you actually skip it down to here. You go to borrowed securities amount, and so forth. So basically, you just figure out which entity you're in, and then follow the steps. Outward investing entity has the most steps. Inward investor and inward investment vehicle have less steps, but basically because they skip this one. They skip the controlled foreign entity debt. And mostly it's because it's talking about controlled foreign entity debt, i.e. lending to a foreign entity. Because if you're an Australian entity lending to a foreign entity, that doesn't really fit the situation because we're talking about inward. We're talking about a foreign investment entity, most likely lending money to the Australian entities. That's why this one's not relevant here. So let's talk about the second part of the equation, which is the maximum allowable debt. So again, remember, average debt, maximum allowable debt, difference is the amount which is disallowed as a deduction. So the calculation of this is the maximum of the safe harbor debt amount, arm's length debt amount, and worldwide gearing amount. We talked about that in the table up here. So the process is always just calculate the dollar value of this, this, and this. What's the largest amount? That's your maximum allowable debt. So this section goes into a little bit more detail. I'm not sure if you need this level of detail, but maybe if you're going in an exam and you need some help into actually calculating the nuances of that amount. So for example, the safe harbor amount is 60% of the entity's assets. This is the table that you can follow. I'm not going to go through each individual step in detail, but what you can do in an exam is just bring this up as you're calculating it. You can plug in each of these values. Maybe it's not relevant in the question. Maybe they tell you the value. if it's not relevant, you just skip to the next one. Go step 1, step 1A, step 2. But that's why it's really important to get this outward investing entity, inward investment vehicle allocation correct, because it has this flow-on effect throughout the rest of the question in terms of how you approach the calculation of each different amount. So I might just spend a little bit more time at the end going through those allocations, just in case anyone has any questions about those. So we talked about arm's length amount, which is basically just the amount they could borrow from a third party, and then the worldwide gearing debt amount is you need to take into account the whole group. What's the maximum gearing of all of the Oz entities worldwide group? Okay, so inward investing entity is not eligible to apply if any of the following entities' worldwide equity or assets is nil or negative. Ordered consolidated FinStats for the worldwide group do not exist. Asset threshold is satisfied when average Oz assets of entity divided by worldwide assets is greater than 50%. So these points all relate to the worldwide gearing debt amount. So depending on in your exam, if it's an inward investor, outward investing entity, and so forth, just have a look through these little caveats. Because there could be a little trick in there just to watch out for. But otherwise, here's the process that you follow. Again, categorize it, then go through the steps. So average value of the entity's worldwide debt, add 1 to the result of step 1, divide the results of step 1 by the result of step 2, multiply, and so forth. So the instructions are right there. It doesn't make sense for me to go through in too much detail. So let's move on to the next one. Most of this is just repeating itself from what we knew above. So let's move on to debt deductions denied, because as I keep saying over and over, it's the difference between the average adjusted debt minus the maximum allowable debt. That's the basically the exceeding the threshold. So in terms of actually calculating what dollar amount of the deductions denied, we're going to use this formula down here. So you calculate your total debt deduction. So let's say we've got $1 million in interest. That's let's do 10 million because of the $2 million de minimis. Everything is going to be below that it's not going to be applicable. So it's merely just meant to catch out these large organizations. So let's do 10 million debt deductions. Okay. So times that by adjusted average debt. So let's say we've calculated this to be $100 million and the maximum allowable debt is $50 million. Okay. Now the average debt is different to the adjusted average debt because remember the adjusted average debt we adjusted for certain things. So let's do a little calculation over here. So we're going to say debt deductions, million. Debt deductions, 100. Adjusted average debt is 75. Average debt is equal to 100. Maximum allowable debt is 50. Okay, so let's say we've gone through all the steps above and these are the values that we've calculated. So to tie everything together, what we're going to do is to calculate the debt deductions denied, we're going to go debt deductions 100 times adjusted average debt minus maximum allowable debt, so they've actually exceeded the threshold, so this should be a write-off, divided by average debt equals 25 million of that 100 million is going to be denied. So they're only going to be able to deduct 75 million of what they've paid, which is 100 million, which means 25 million is denied. So that's basically how we calculate this. Okay, so let's move on to the third type of actually transferring or shifting profits between jurisdictions is transfer pricing. So this is what we mentioned before. Is when companies, especially large corporates, will shift profits overseas either through management fees, through pricing of assets. So they might price something really low to their parent company in Ireland. They buy it up, the Australian company is going to make a loss because they've paid for cost of goods higher than what they're selling it for. They're not going to pay any profit in Australia in the high tax jurisdiction. They're going to shift their profit to these countries with low tax, and they're going to pay low tax in those companies. So the purpose of transfer pricing is to prevent that by setting certain standards around what is okay in terms of setting prices on things like management fees. What's an acceptable management fee? What's an acceptable price on certain goods and so forth? Okay, so basically international dealings between two parties should be fair return for activities performed, for assets used, and for the risks assumed in performing those activities. Any pricing that does not reflect the above may be termed international profit shifting when it occurs between a resident and a non-resident. I.e., Australian tax can be avoided if deductions are shifted to Australia, e.g. a resident buys goods from a non-resident at inflated prices, or income is shifted offshore, e.g. a resident sells goods to a non-resident at a discounted price or interest-free loan made offshore. So subdivision 815B ensures amount brought to tax in Australia between entities reflect arm's length contribution by Australian operations. Subdivision 815C ensures amount brought to tax in Australia through a branch is not less than if a branch were distinct and a legal entity. So both of these subdivisions basically say we look at your prices, and if they're not market value, we're going to adjust it to what we think market value is to prevent international profit shifting. So the application, so there will be transfer pricing benefit if the conditions are not arm's length. So both parties must be acting in arm's length, both acting in their own best interest, not in the worldwide group's best interest. Number 2, conditions satisfy a cross-border test, either or both entities to be non-residents that are not operating an Australian branch, either or both entities to be Australian residents that operate a branch, a business entity that carries on to be in an area covered by an international tax treaty. So basically saying that, okay, number 1, the conditions are not arm's length, like you're paying below market rates or above market rates. Number 2, you're paying across into an international country. Number 3, or jurisdiction. Number 3, your taxable income withholding tax liability would be greater if operated on actual conditions. So it's actually impacting your taxable income or your withholding or your tax payable. So if all 3 of those conditions are met, then transfer pricing has occurred. So the consequences of receiving a transfer pricing benefit, which is very bad, is basically substituting the arm length conditions divided by profit amounts. So what they will do, and what this table is saying, is basically if you had reduced your taxable income because of your transfer pricing, what these divisions are going to do is, which are anti-tax avoidance, is basically we're going to increase your taxable income by the amount we've calculated you've reduced your taxable income by. Same thing for tax losses and tax offset and interest. So the ATO is going to come in, it's going to adjust all those numbers, it's going to calculate what the difference it thinks it is, apply it to your taxable income, tax loss, tax offset, interest withholding, all that stuff. Now, there's different methodologies for actually calculating the transfer pricing methodology. And this is how the ATO comes in and says, well, you're actually not paying market rate. So there's comparable uncontrolled price method, there's cost plus method, there's resale price method, there's transaction net margin method, there's profit slip method. So, but it's really quite qualitative and grey area, because for the ATO to come and say, oh, this isn't fair value market, they have to prove it's not fair value market, right? It's kind of hard to, especially if the ATO is not experienced in a particular industry, how do they say that something's not fair value? But, some situations it's really obvious, like they're not charging anything for a product, that's clearly wrong. But it's the grey areas is when it's, slightly below, maybe it's slightly cheaper. It's hard to say, In that area, it's probably a bit of a grey area. And then finally, transfer pricing documentation must be maintained, and so forth. Okay, and then just this small last bit down here, which is country by country reporting. It's basically just saying that each countries have reporting between each other, especially for the listed countries. They've got fairly good tax reporting. They talk to each other about cross-border transactions between companies and so forth. Just they can just cross-reference this and look for transfer pricing. So that's basically it. That's the end of the international avoidance chapter. It's fairly complicated. It can be quite tricky. just make sure, in summary, just make sure you have a good understanding of the classifications of entities. Maybe do a couple of worked examples, just practicing the application of these tables and making sure that you are able to accurately apply the correct category of business, and maybe just go through a few processes. The tables I found were always a little bit confusing. Generally, you can just get the information from the question if you just follow this table over here, which is just a high-level guide as to actually how you calculate those deductions and the amount that's going to be denied. Transfer pricing is fairly straightforward. You don't generally get a lot of questions on it, but you may get questions on thin cap. Anyway, hope you found this useful, and thanks for watching our videos again. See you later.